Okay, so please go to slide on page 128. Last week, we've done first case, your bond issue at discount, right? 折价发行. So today we'll talk about issue at premium. If you understand discount, actually you understand premium. Same structure, same concept, but with opposite direction. That's it. Okay, so on slide 128, before you do anything, remember, the first thing is what? Figure out your products, right? So what's your product? First, principal, $100,000. Second, for 5 years. Third, your contractual interest rate. Last one, you pay interest annually on January 1st, okay? So same product right here, but the problem is we go to ask the second investor, right? So second investor, what they want? Market interest rate is what they want, right? So they want 9.4794%. So before you do anything, you have to understand, based on this product, this case, your bond issue at premium or issue at discount? Issue at premium, right? Why? Because your promise is 10%. What they want? 9.4794%. You provide higher than what they want, right? So you can sell your product with higher price because they think your product is good, okay? So before you do anything, you have to make your own judgment to figure out your bond issue with a higher price or low price, okay? So in this case, your bond issue at premium. So you can sell your bond with higher price, okay? Then interest payment, you promise pay the interest, right? So what's your promise? You promise based on principal $100,000, based on your promise contractual interest rate 10%. So you promise pay interest $10,000 each period, right? So don't forget, interest you paid is based on what? Based on your promise. Okay, so that's why we use your promise principal. We use your promise 10%, okay, to figure out how much money we are going to pay for interest, $10,000, okay? So after you understand your products, first issue always, market value of the bond. So what does it mean? How much money you can borrow from investors, right? When you are going to sell your bond, how much money you can borrow? Okay, so based on what? Principal's present value plus interest present value, right? So based on principal's present value plus interest present value, you can use accounting table, use the formula, or use calculator anyway. So for your final exam, I will provide accounting table, provide formula to you guys. So you don't need to memorize the formula. So anyway, which tool you are going to use? The important thing is what? What's N? What's I, right? So what's N? What's I? What's N? What's I? Right? So N means what? How many times interest occur, right? So how many times? Annually. So one time for each year. How many years? 5 years. So what's N? 5. What's I? Market interest rate, right? So market interest rate is 9.4794%. So after you understand what's N, what's I, then you can use accounting table, use formula, either way, okay? So after that, how much money you can borrow? Go to your slide on page 130. So what's your N? 5. What's your I? 9.4794%. So based on N5, I 9.4794%. So how much money you can borrow? Is $102,000. Okay, so $102,000. This is the amount you can borrow from investors. Okay, so see, it's our expectation. So what's our expectation? We can sell the bond with higher price, right? So indeed, we sell the bond with higher price. Okay, after you finish the first issue, how much money you can borrow? So what's the second issue I want to talk about? Don't forget, when we talk about you owe someone money, you borrow money from investors, what's the issue always we have to consider? Interest, right? So don't forget about interest. That's why we talk about our second issue right here. So on your slide 132, right? We talk about the interest. So don't forget, what's the first interest we have? Your promise, right? So your first cost of borrowing is the interest you paid, right? Based on what? Your promise, right? So your promise is contractual interest rate. So we have a first cost of borrowing, first interest based on your promise. But don't forget, we have a second cost of borrowing, right? So our second issue is we want to consider our second cost of borrowing right here. So that's our second cost of borrowing. Okay, so we want to talk about that. But remember, since we paid our first interest, how often? Each period. So we pay our first interest each period. At the same time, we want to know our second cost of borrowing each period. Okay, so our point is for our second cost of borrowing, we want to know each period. How much it is? So remember, when we want to find out our second cost of borrowing each period, which method we use? Which method we use for our second cost of borrowing each period? Effective interest method, 有效利率法. Okay, so when we want to know the number for each period, we use effective interest method. Okay, effective interest method is the way we use trying to find out our second cost of borrowing for each period. Okay, so no matter your bond issue at higher price or lower price, your bond issue at a discount or premium, the same structure, the same concept right here. Okay. No problem? Okay, so let's look at today's case. So what's our today's case? Issue at premium, okay? So your bond sell with a higher price. So let's look at this case right here. Remember, how much money you can borrow? You can borrow $102,000, right? We just got this number, right? So this is the amount you can borrow today. But what's the problem? The problem is after 5 years, how much money we have to pay back based on your promise, right? So what's your promise? Principal, $100,000 is your promise. So always keep your promise. So what does it mean? After 5 years, you promise pay principal $100,000. Okay? So this is your promise, principal. You promise to pay back $100,000. Okay? So, did you find out how much money you got? $102,000? But you just need to pay $100,000. Okay? So what does it mean? You got $2,000 more today, right now. Okay? So based on your second cost of borrowing, did you find out? You received $2,000 more now today, right? So this $2,000 is what? Is your premium, 溢价部分。Okay? So did you find out for our second cost of borrowing, it's a little bit different. Why? When we talk about issue at discount, you borrow less money, you pay more money back, right? So it means what? You have second cost of borrowing, right? But here, you got more money today. So your second cost of borrowing actually will make your total cost of borrowing decrease, right? Because you got more money. So, except your first cost of borrowing right here. So did you find out? Your first cost of borrowing the same. Because based on your promise. How about your second cost of borrowing right here? Your second cost of borrowing, this number actually will make your total cost of borrowing decrease. So this one will make your total cost of borrowing decrease. Okay, because you got $2,000 more, but you don't need to pay this $2,000, right? So that means your total cost of borrowing decrease, okay? So be careful right here. For your issue at premium, 溢价发行, your second cost of borrowing actually is negative, minus. So negative minus means what? Make your total cost of borrowing decrease, okay? So here, your second cost of borrowing, be careful, they will make your total cost of borrowing decrease. Then why your second cost of borrowing make your total cost decrease? Why you can get $2,000 more at the beginning? Because remember, when we talk about actual cost, how much money you had to pay, what's the cost you have in order to borrow money from investors, always is market interest rate, right? Only when you satisfy what they want, you can borrow money from them, right? So what they want in this case, they want market interest rate, right? So the market interest rate they want is only 9.4794%. They only want 9.4794%. The problem is, for your first cost of borrowing, how much money you pay? You promised 10%. So you pay 10%. They only want 9%. You pay 10%, right? So you pay more right here. You pay 10%. But what they want? They only want 9.4794%. Okay, so based on these two, did you find out you pay 10%, but investors only want 9.4794%. Okay, so you pay more, right? So you pay more each period. You pay more than what they want. So that's why at the beginning you can got $2,000 more. You got $2,000 more to compensate. You pay more for each period, okay? So this $2,000 you got at the beginning. This $2,000 you pay more. You got more, sorry. You received $2,000 more. Why? Because to compensate, you pay more for each period. Okay? Any questions? So each period you pay 10%. They only want 9.4794%. So each period you pay more. Pay how much? Each period you pay 0.520% more. Okay, so that's why based on 0.520%, you pay more each period. That's why you receive 2,000 in total at the beginning. Okay, so remember for issue at premium, you got $2,000 more. That will make your total cost decrease in order to meet market interest rate. Okay. Okay, if you don't have any questions, so based on this, our purpose is find out $2,000 for 5 years. How much for the 0.5 to 0.6%? How much for each period, okay? So the same, how? Before we go to that, on next slide, 134. So here I told you we have two cost of borrowing, right? So first one is what? The 10% your contractual interest rate. So this is your first cost of borrowing for the 10% contractual interest rate. Okay, and what's the second? Our second cost of borrowing. Your second cost of borrowing is the premium, right? But don't forget, your premium you got $2,000 more. So your second cost of borrowing, you receive $2,000 more. Okay, which will make your total cost of borrowing decrease, right? In the beginning, $50,000. Because of your second cost of borrowing, made your cost decrease $2,000. So did you find out in the end your total cost of borrowing only $48,000? Okay, so they will make your total cost of borrowing decrease. Okay, so when we talk about what's your total cost of borrowing, first plus 2, right? But be careful, when we talk about premium, your 2 should be minus, negative. Any questions? No problem? Okay, since you understand your total cost of borrowing, how much? First one, your contractual interest rate minus your premium. second cost of borrowing. So we got our total cost of borrowing. Okay? No problem? Okay, so let's find out our premium for each period. How? Using effective interest method. Okay, so on slide 136, here again, premium amortization, 溢价摊销. So what does it mean? Trying to find out our second cost of borrowing for each period, okay? But here is for your premium, right? So we call it premium amortization, 溢价摊销. Trying to get your second cost of borrowing for each period. Okay? And your second cost of borrowing in this case is premium. Okay? And also don't forget, premium will make what? Make your total cost of borrowing decrease. So we have a discount amortization, premium amortization, 折价摊销, 溢价摊销, but actually we talk about the same thing, but depends on your bond issue at high price or low price, okay? Any questions? No problem? Okay, so let's look at effective interest method, 有效利率法, trying to find out your second cost of borrowing for each period. So on your slide 138, again, based on your first cost of borrowing, right? And we talk about premium. So remember, premium, that's why it's negative minus. Since we talk about the premium, so it's negative minus, right? Because they will make your total cost of borrowing market interest rate decrease. Okay, then how to get our first cost of borrowing? First cost of borrowing, interest you paid, always based on what? Your promise, right? So what's your promise? Contractual interest rate times your promise principal. So you promise to pay the interest $10,000 each period, okay? So your first cost of borrowing always based on your promise, okay? Then do we know the second cost of borrowing? So far, it's quite hard to get our second cost of borrowing. That's why we find out our total cost of borrowing first, okay? So how to find out your total cost of borrowing? Based on what they want. So what they want, market interest rate, okay? So in this case, what they want 9.47, I forgot, 4794%. 9.4794%. So based on investors' want, market interest rate 9.4794% times what? How much money you owed, right? So how much money you owed? Your liability, right? So based on how much money you owed, so your liability. Okay, but be careful. How much money you owed, we mean when, which time? Beginning, first day, right? Because interest incurred always based on your time. So we mean your first day, beginning. So how much money you owed, we mean your first day. Okay? Based on the first day, how much money you owed. And when the time passed, interest incurred, okay? So today, if you borrow money today, will we have an interest today? No, okay? So interest incurred happen always next day. So that's why based on the first day, how much money you owed, and the time passed, interest incurred, okay? So that's how we got our total cost of borrowing. So you know the first one, you know the total. Can you get the second one? Yes, right? So your total cost of borrowing minus your first one, then you got your second one. Any questions? So it's the same as last week. The only difference is, be careful, premium here is minus, negative. For discount here is plus. Discount, you will make your total cost increase. Premium will make your total cost decrease. Okay, any questions? So based on this, we just convert into Excel tables, right? So when we convert into Excel on your slide 140, remember, first column is what? Interest payment day, right? When we pay the interest. So how about your second column? Is our first cost, right? How about your third column? Is your total cost, right? How about your next column? That's our purpose, right? Our purpose is we try to get this, your second cost of borrowing. So that's our purpose. Any questions? Then, how about last one? Last one, we mean your liability, right? So first day, your liability right here. So how much money you owe? How much money you borrow? $102,000, right? Okay. So first day, how much money you owed? Is 102,000. Oh, sorry. Is $102,000. $102,000. Oh, wait a moment. My God. Okay. Then on the last day, what's the number? $100,000, because at the maturity day, we promise pay principal $100,000. Okay, so I know this number should be your principal. So it should be your promise $100,000. Okay, then can you tell me your liability increasing or decreasing? Your liability should be decreasing, right? But why? From first day, $102,000 to last day, $100,000 only. So your liability should be decreasing. Okay, but why? Why liability decrease over period? From first day 102,000 to last day only $100,000. So your liability should be decreasing over period. But why? Why is that? Why? Why? Tell me why it's decreasing. Do you have any answer? Can you guess? Why liability is decreasing over period? It's okay. I finish the first period, then you will understand why. Okay. So go to slide here, 143. For example, I finish the first period, then you will understand why. Okay. First day, You borrow the money, $102,000. This is the money you borrow, right? Then, in the end, you had to pay principal, right? So principal is 100,000, okay? Then why the liability is decreased? Let's look at your first period. First cost. Your first cost of borrowing, $10,000 based on your promise, right? So means what? Each period you have to pay interest $10,000, okay? So $10,000 is the interest you paid. Means what? You really give the money. You really use your cash, $10,000 to pay the interest. So interest paid each period. Okay? But the problem is what they want. They want market interest rate, right? So based on your liabilities, how much money you owed at the beginning? $102,000, right? So based on the money you owed, $102,000, what they want? 9.4794%. So they told you the interest they want only $9,669, okay? So this is the interest investors want. So did you find out? Investor want only $9,669, but you pay $10,000, right? So you pay more money to investors. How much money you pay more? The difference, right? So the difference is your second cost of borrowing. So $331, your second cost of borrowing. This is your second cost of borrowing. Okay? Also means what? Means you pay more money for each period. So this $331, you pay more. This period. Okay? So you pay more money each period from your second cost of borrowing. Okay? So that's why, since you pay more, right? So means what? That will make your liability decrease. You pay more, then you can pay some liability for each period. So did you find out for your first period, your liability should be decreased from your second cost of borrowing, okay? So at the beginning, you have the liability, how much? $102,000, that's the money you borrow. But when you pay $2,000, when you pay $331 more, so that will make your liability decrease, okay? So you pay more. From your second cost of borrowing. Okay? So that's why your liability should be decreasing over periods, because each period you will pay more money to them, okay? So that's why on the last day, you just need to pay $100,000. Any questions? See? So did you find out your premium is negative, is minus. That will make your total cost of borrowing decrease. Okay? So your liability decreasing from your second cost of borrowing. Any questions? No problem? Then please go to your handout, finish page 37, 38. 37, 38. Your handout on page 37, 38 is about your bond issue at premium, 溢价发行. So find out your products and find out how much money you can borrow. Then find out your second cost of borrowing. If you finish, that's your product on page 37. So before you do anything, you have to understand your product first, right? So that's your product. So based on your bond, your product right here, then you can answer the first issue, first question. How much money you can borrow, right? So based on the product you have right here, okay? So first issue, what's N, what's I? 10 is N, what's I? 4%. So based on N is 10, I is 4%. How much money you can borrow? Okay, $108,111. Okay, so based on your N and I, you don't need to use the accounting table. You can use the formula either way. Okay, so when you use the formula, still you need to know N and I. Okay, so don't forget, first issue, find out how much money you can borrow. So this is the money you can borrow. And use the money you can borrow, then you can finish the page 38. Okay, if we finish, you can double check the answer right here. So see, the first column always the same because based on your promise, right? So don't forget, your promise contractual interest rate is always the same. Second column, what they want, based on the market interest rate, what they want, 4%. And we got our second cost of borrowing. So second cost of borrowing means what? You pay more each period. So each period, they want only $4,324, but you still pay $5,000. So you pay more money for your second cost of borrowing. So that's why your second cost of borrowing will make your liability decrease, okay? And be careful for your last period. Don't forget, last period, the last day always should be principal because that's your promise. So don't forget, always keep your promise. Okay, any questions? So see, totally the same as last week when we talk about issue at discount. The only difference is, remember, here, your second cost of borrowing premium is negative minus. That's it. Others totally the same. Any questions? No problem? Then let's take a break. Okay, after break, we will use the data number right here to write down the journal entry. That's it.